Hi everyone, welcome back to Be Rich. This is the third time and I hope it's a charm. Happy Wednesday, midweek. And so I've done this 3 times today and I hope this one sticks. I hope it lands. So one of the questions that I've always been asked, me, Kesav, and all of us is, as value investors, you guys always tell us to buy. Buy. And that's all fine and dandy, but when do we sell? It can't be that we always keep buying and never sell. It's like always asking you to breathe in the air. Nor do you ever asked to hold your breath, nor do you ever allowed to exhale your breath. What is this constantly you guys keep saying, just one direction, omnidirection? It's true. It's not a great thing to do. You should always have variety in life, as Kesav says. He always likes to have Bel Puri, Kesav. He doesn't like his things segregated. He likes it all mixed together. So it was his inspiration that got me down to this video today, and that is, I'm going to give you 11 instances where it's a good opportunity to sell and why you should capitalize on these opportunities and sell. So the first scenario where you might want to sell is something known as over-evaluation. Over-evaluation is when the stock which you have been buying has grown up considerably in value so much that it doesn't make sense holding on to it. For the simple reason, the market has gone crazy, as Warren Buffett says, and Mr. Market has gone crazy, and he's driven up the prices of the stock and your investment so high, you might as well liquidate these positions and wait for the correction and re-enter these positions all over again at a much lower cost. So what does it give you? It gives you an opportunity to take out some extra cash which is sitting on the table for free. For example, let's say you're looking at a company A, which is priced at $100. And you bought that company at $50, right? And the intrinsic value you estimated to be around $100. And the price from $100 has shot all the way up to $300 now. And you know, market has reached a crazy evaluation looking at the PE and all other metrics. You know, this cannot be sustainable and this stock has to correct. It may correct all the way down to $100, or it might correct even to $200 and hold there. But you know, from $300, there's not much room left, and it's not going to go up any much higher. Even if it does, it's going to be only a percentage of maybe 5-10%. And you're willing to forego that and move in at a correction point, because you sell at $300 now and you book in your profit, and let's say it corrects at to $150. You can buy more of that share, more of that stock, even if you don't need that money. So this is a strategy called over-evaluation, and that happens sometimes. Like when the market crashed during the pandemic crash, we bought, let's say, IndusInd Bank at a very low cost. Now it's gone 3-4 folds up. So you might sell those positions and move into the next bear market, which we are all expecting imminently. But mind you, remember, it's a waiting game. So you might sell it at $300, like I said. You might even see it going up to $350, $360, but you should be willing to put up with the pain. That is the question. Can you put up with the pain? So this is called the overvaluation strategy, which some people employ. And if you wait till the end, I'll tell you the strategy which is going to make you most happy. The strategy which I'm sure all of you will want to do, which I've saved till the end. Second strategy, reason why you'll sell, is called fundamental deterioration. Fundamental deterioration is when the stock has lost its fundamental intrinsic value have deteriorated. That means there's a change in management, there's a management issue, or there's a market change, there's a headwind issue, where the industry itself is changing. Let's say you bought Kodak, and a company bought that's like making film for film cameras, and you know the digital technology is coming imminent, and it doesn't make sense holding on to a company which makes film anymore, and you decide to exit because the fundamentals have changed. Or, for example, you've bought in a company where the management is very sound, it's a very great management, but during the process of sale, that management has all existed, and now you've got a new set of management, or a new set of board directors sitting there, and their vision doesn't align with your vision for what the company should be doing, then you should exit. So this is called fundamental deterioration. That's what you should look at. Okay, the other is change in investment thesis. So what's that? That's if the original reason for buying the stock itself changes. So it's prudent to sell. So what would that mean? That would mean, let's say, the competitive edge for the company has changed. It's not competitive anymore. That, for example, would be like Nokia. Nokia was ruling the cell phone industry for a very long time, and everybody wanted to buy a Nokia phone, and everyone wanted to own the Nokia share. But then you could see the writing was on the wall with Apple phone, and Nokia doesn't seem to be changing, doesn't seem to be tacking and moving with the direction of smartphones. Then you should know it's time to sell Nokia. So the company's basic thesis of why you own that company itself has changed. So you don't own it anymore, and you don't want to be in it because you know fundamentally what the company is doing is flawed. Fourth reason, better opportunities. Let's say you're sitting in a company with an investment and you're happy and dandy, like I said, that $100 and now it's gone to $300 and you don't want to sell it, but you see another company you've been eyeing for a long time and that's gone well below its intrinsic value, and you know that company is a far better hold than what you're holding currently, then it's something to sell. You have to sell and move into this position you've been waiting for a long time and happily move into that because you have done the fundamental analysis and you see a much wider margin of growth there. So you move into that. So that's called a better investment opportunity, and that's the reason you sell. What is the other reason you sell? It's called risk management. Risk management is when your portfolio, you've been diversifying and you've been sitting in. So what has happened is your portfolio itself has become very lopsided. That means you own too many, let's say, cement stocks, or you own too many auto stocks. And you realize your portfolio has become very dependent on the pharma sector or the IT sector. So you need to diversifying your portfolio. So that's the reason you sell. So to manage your risk and the exposure to the market, you want to diversify and spread your bets. So you decide to liquidate a certain company or a certain share so you can diversify your portfolio. So you look at 4 or 5 companies which you own in that sector and say, okay, which one I don't mind losing? Out of the 3, which one should I sacrifice and move into another sector to diversify my portfolio? And so you sell. That's called risk management. The other is, let's say you bought a stock for dividend because they pay out a very great dividend. And you've noticed the last 2 years, the dividend payout hasn't been so great. And the foreseeable future, the earnings don't look so great. And the dividends doesn't seem to be as big as it used to be. And it doesn't make sense holding on. One would be any government company stock which you own, which you bought for the sake of the dividend it gives, like an FT dividend. It's not there anymore, sell it, move on. The next reason which you should do is called tax consideration. Tax consideration is that you see there's a change in capital gains tax, or there is a loss which you can accumulate, which I spoke about in yesterday's podcast. Let's say for a tax benefit, you take this loss onto your books so you can write off some other profit because of this loss. You can do that. It's called tax consideration. Or let's say the finance minister has declared some new capital gains rules which is going to come into effect 2 months from now. So you liquidate your positions to avoid those capital gains. Then you move into those stocks, same stocks again in the current price, avoiding the capital gains because you've reset your prices. So that's another strategy people use. The other reason why you may sell is some value investors have a specific target in mind, price target. When you reach that price target, you book your profits and move on. That means they never intended to hold the stock for a long term. They don't see this as a long-term stock. They saw this as an opportunity or an arbitrage in the market. So they bought the stock just to see through the arbitrage, like IDFC or Tata Metallinks, what we're talking about. You might take this position just as an arbitrage. So you've taken a huge position in it. And once you've seen that profit or that arbitrage price point, you exit and you move into the stocks you want to hold long term. So that may be another reason why you sell, which is reaching your target price. The other is what we have already spoken about, which is called the lack of conviction, where you've lost confidence in the company, which could be for any reason. Could be the reason change in management, or change in the company's headwind, or it could be a change in the kind of, let's say you've invested, diversified in the American market, you've lost conviction in what's happening in the US, or macroeconomics have changed. So you've lost faith in what's happening and you pull yourself out. This ties in with the next one, which is called external economic factors or market factors. Fundamentals in the market are changing. Fundamental in the countries or macroeconomics are changing. So it's time to move out of the stock market and move into the bond market, or exit the bond market into the stock market because of interest rates. So these could be another reason why you could be selling. This is the last reason, which is the reason why many of you will be happy to sell. And I will be very happy if you do sell for this reason. Other than all the other reasons, if this is the reason you're selling, I'd be very happy, which is the reason which I've been holding out to the end, which is personal finance goals. All of us have been stressing on this. most of my videos is we set goals to reach. Let's say it is to buy the next iPhone, or it is to buy the next car, or go on the holiday. So you've been investing for the 3-4 years to reach this goal, or your education, your child's education. So you've been investing to this goal, or your retirement. You've reached your goal now. It's time to enjoy those benefits. What you worked so hard, and you've been foregoing your immediate requirements, postponing them for another better day. That better day has come. So for your personal goal, achieving it, you sell your stock and you liquidate all your positions, and you start living the retired life you've been dreaming of, or buying the product or going on the holiday you've been dreaming of. So anyway, these are broadly the points for which, as a value investor, you can liquidate your positions, and you may happily sell those positions you've been holding on to. So it is not always buy, or hold, as Anand says, or I say. There are times to sell, and there are good times to sell, and there are good reasons to sell. And I hope you have understood these reasons, and you keep them in mind whenever there's an opportunity to sell. Do book in your profits, cut your losses if you have to, or do go and enjoy your personal goal which you have achieved now. Pat yourself on the back. It's much deserved. Thank you for watching the podcast today. I hope I clarified all your doubts, and I'll see you in the next one soon. Thanks.